Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else. Friends, welcome to another video on your channel Profit and Equities. If you like our content, please don't forget to hit the like button. Also, subscribe to our channel, click on the bell button and choose all notifications to receive important financial updates from the world of finance at the earliest. In this video, we will be talking about 4 fundamentally sound stocks from the consumption space which could be potential multi-baggers in the future. Also friends, this is not our own research report. This is part of a research which was done on a financial news website, and we'll be providing the link to that article for you to go ahead and build more conviction around your investing decision. Please watch this video to know more. Now the first stock on the list is Saawariya Consumer Limited, which is available at Rs 14 and the face value for the company is 1. The symbol for it is SANWARIA. Now Saawariya Consumer Limited, formerly Saawariya Agro Oils Limited, is an India-based fast-moving consumer goods company. The company is engaged in the manufacturing and selling of rice, edible oil and staple food products such as pulses, sugar, soya chunks, wheat flour, rice flour, salt, suji, maida, besan, dalia and also soya meal. Now the 1-year chart shows that for the first few months of the year the company was literally flat, then had a huge spike, but in the recent market correction this company has been on a severe downtrend. The market cap of the company is 1030.54 crores, which means that the company is a small cap one. The EPS of this particular company is 1.36, which translates into a price to earnings ratio of 10.29, which is much cheaper compared with the industry PE of 16.56. The company has a book value of 4.48, which again translates into a reasonable price to book ratio of 3.13. The company's dividend yield is 1.07, whereas the promoter holding for this company is a strong number at 66.69%. Now quoting from the research report, Saawariya Consumer, one of the largest integrated food processors in India, reported a 24% growth in top line and 133% growth in net profit in the March quarter. Over the past 3-4 years, Saawariya has changed focus from commodity processing to end products. Now it has launched products under its own brand and has also entered the retail segment with the rollout of Saawariya Consumer Shoppe, which is basically its brand of Kirana outlets in Madhya Pradesh. It has also signed a deal with Patanjali to supply soya chunks to it. High debt remains a concern, though the promoters recently infused Rs 100 crores through a preferential allotment to repay a part of the loan. The company plans to raise another Rs 400 crores towards working capital, capacity expansion and acquisitions. The realizations of rice and soya bean have improved considerably, and this bodes well for a company like Saawariya, which derives 75% of its revenue from these two products. The company is gradually transforming itself into a branded FMCG company, which should improve margins and thereby the earnings for this company. Now the second stock on the list is Gujarat Ambuja Exports Limited, which is available at Rs 213.70 and the face value for this company is 2. The symbol for it is GAEL. Now Gujarat Ambuja Exports Limited offers raw and refined soya oil, maize, starch, soya, de-oiled cake and liquid glucose. The company's segments include cotton yarn, maize processing, agro processing, power and others. Now if you were to look at the 1-year chart, you would see that this company has been on a beautiful uptrend for the major part of the year, but it has corrected somewhat in the recent market correction. The market cap of the company is 2450.45 crores, which means that the company is a mid-cap one. The EPS of 15.69 translates into a price to earnings ratio of 13.62, which is cheaper compared to the industry price to earnings ratio of 16.56. The book value for the company is 90.08, which translates into a price to book ratio of 2.37, which also is not wildly expensive. The debt to equity for the company is 0.6494, whereas the dividend yield provided by the company is 0.37. The company's promoter holding is also a strong number at 63.76. Now again quoting from the research report, Gujarat Ambuja Exports is one of India's leading manufacturers of agro-processed products and cotton yarn. Now Gujarat Ambuja Export Limited's revenue for the March quarter declined by 18% to 881 crores, but net income more than doubled to 79 crores. The top line was subdued as the company has shifted focus to manufacturing from trading of agro-processing commodities. The margins improved on the back of higher contribution from the manufacturing capacity. Now, Gujarat Ambuja Export Limited has recently started operations at its 1000 metric tons per day maize processing plant at Chalisgaon, Maharashtra. With this, Gujarat Ambuja Exports Limited is now the largest maize processor in India with a total capacity of 3000 MTPD and a market share of 21 to 22%. The company is expected to benefit from the drought in Argentina, the third largest soybean producer in the world. Soybean production in Argentina has fallen 30% this year. Lower production in Argentina has resulted in GAEL gaining competitive advantage in processed exports. Besides, Gujarat Ambuja Exports Limited will also benefit from improvement in crushing margins and soybean realizations as soya prices have increased 20 to 25% in the last 6 months. Now, the third company on the list is CCL Products India Limited, which is available at 280.55, and the face value for this stock is 2. The symbol for it is CCL. Now, CCL Products India Limited is engaged in the manufacturing of instant coffee. The company operates through the coffee and coffee related products segment. Now, the 1 year chart shows that this company has literally been flat throughout the year and there has been no major price change. It is almost closing the year at a level below what it started at. The market cap of the company is 3,732.10 crores, which means that the company is a mid-cap one. The EPS is 7.35, translating into a price to earnings ratio of 38.17, which is slightly more expensive compared with the industry price to earnings ratio of 32.14. The book value for the company is 48.35, which means that the price to book ratio is also a bit high at 5.80. The debt to equity for this company is 0.4362, whereas the return on equity stands at 0.2154. The dividend yield provided with this company is 1.25 and is a decent number, whereas the promoter holding is below average at 45.02. Now, the research report says that CCL Products is India's largest manufacturer and exporter of instant coffee. The company has an installed capacity of 30,000 metric tons of instant coffee across India, Vietnam and Switzerland. Now, CCL exports coffee and related products to more than 60 countries across the globe. The company's consolidated revenues for the quarter rose 7% to Rs 321 crores and net profit PAT rose 33% to 47 crores. Growth has been driven mainly by the strong performance from Vietnam operations. As the India capacity is working at nearly full utilization, CCL is looking to grow its customer base in Vietnam after the commissioning of agglomeration capacity in the region. The prices of green coffee have started decreasing and this might result in growth moderation as the customers have started to delay purchases in a low price environment. Accordingly, the management has given a conservative revenue growth guidance of 10 to 20% in the current financial year, excluding the new plant capacity. The new plant is a high margin business and will further aid the profitability of CCL as the volumes pick up. Now, the fourth and final company on the list is Quick Heal Technologies Limited, which is available at Rs 298.45 and the face value for this stock is 10. The symbol for it is QUICKHEAL. Now, Quick Heal Technologies Limited, formerly Quick Heal Technologies Private Limited, is a provider of security software products and solutions in India. The company is engaged in the sale of internet security products and software support services. Its antivirus products are available across all the 4 segments: retail, small and medium business, which is SMB, enterprise and mobile. Now, the 1 year chart shows that this company was on a consolidation mode for the initial few months of the year, then had a vertical rise, but since then has again corrected. The market cap of the company is 2100.74 crores, which means that the company is a borderline stock between a small cap and a mid cap. The EPS of 11.21 translates into a price to earnings ratio of 26.62, which is slightly more expensive compared to the industry PE of 21.82. The book value is 107.72, which translates into a reasonable price to book ratio of 2.77. The debt to equity for this company is 0.0016 and the dividend yield is 0.84. Now, the promoter holding for this company is a strong factor and stands at 72.57. Now, the research report states that Quick Heal Technologies provides security software products and solutions in India, Japan, Kenya, the United Arab Emirates and other regions. The company has a strong footprint in both the retail and enterprise segments. It has 30,000 plus enterprise and 8.4 million active license users and has a 34% market share in the retail segment. The company operates in the retail and enterprises segment and derives around 80% of revenues from the enterprise segment and the balance from retail. Renewal rate for retail segment stands at 35%, while that of the enterprise segment is much higher at 75%. The management wants to increase the renewal rates in both the segments to aid long-term revenue visibility. Now, the market opportunity for internet security services is huge, and there are more than 50 million mobile and laptops on the retail side. Small and mid-sized enterprises, which form a major part of the enterprise segment, has a market size of 40 million, and these enterprises are gradually integrating technology with their businesses. In general, the cyber security market is vastly underpenetrated and provides ample opportunity for growth amid concerns of data privacy. Now, Quick Heal plans to replicate the success in the consumer security segment to expand its coverage on the enterprise segment. The business is highly scalable and enjoys high operating leverage and looks well positioned to grow in an increasingly digital world economy. Now friends, please don't consider this to be a stock recommendation on our part. Please go ahead and do your own research. This and all other content that you see on our channel is intended to be a piece of news. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.